Hi guys, welcome to MCQs of CA Inter Financial Management. Our aim is to be spreading quality education at perfectly no cost. That is why every Saturday, Sunday we come out with lectures of costing of CA Inter, which is enough for every student to be getting 90 plus in costing. Let's start it off. MCQs. MCQs of CA Inter Financial Management from the module. In module, there is only final answer. We are just making an attempt to be explaining everything in a proper way, which acts not only as a revision, but gives you the proper logic of the correct answer. Let's start off with a question for today. Please do note that every question of CA Inter costing is already there on our YouTube channel. Now, the MCQs of CA Inter Financial Management are coming out. Okay, so let's start it off the question for today. So the question is, external sources of finance do not include. Do not include. Please note that word, not include. Okay, so debentures, retained earnings. Third, overdrafts. And lastly, leasing. This is easy. External sources of finance do not include. So tell me the correct answer. Comment please. Now, I'll try to say something about all the things that are over here. All the things that are over here. Debentures, retained earnings, then overdraft and leasing. Okay, so ultimately, we have to say external sources do not include. Please do remember. Let's start it off with debentures. Now, debentures is the capital that is in form of a loan. Okay, that is one thing. Second, it's always external. It is raised from outside. Okay, from the people. We issue debentures to the general public. Okay, they all subscribe to the debentures. So therefore, it is external in nature. And just to add on, it is always long-term in nature. Debentures satisfy long-term needs of any company. That is first. Okay, Second in this case is overdraft facility. Now, overdraft facility, who gives you the overdraft facility? So the bank gives. Okay. So therefore, it is external in nature. External in nature. Somebody else is giving you this money. Now, just one thing for those people who don't know, in overdraft also, there are two types of overdrafts which are there. You have a normal overdraft, you have a clean overdraft. Okay. Normal overdraft, you keep something as mortgage and bank will give you a facility to overdraw from your account. Okay. So therefore, if suppose your overdraft limit is say 10 lakh rupees, then your current account balance can go up to 10 lakhs negative. Okay. There is something called as clean overdraft also, whereby you do not have to keep anything as mortgage. Okay, it is only for high profile clients. Okay, so bank has to see the credit rating up and so on, and they give clean overdraft facility also. Of course, clean overdraft facility rate of interest will be higher as compared to normal overdraft facility because there is no mortgage over here, just out of interest I told. And overdraft usually will be satisfying short-term needs of any organization. Your overdraft facility has to be renewed year after year. Okay, it's precisely for making temporary arrangements of money. So therefore, it's always short-term in nature. Suppose you issued a check to somebody, but then you do not have enough amount of balance in your current account. Bank will still honor that check if you have taken OD facility. Okay, so this is the second one. The third one in this case is leasing. Now, everybody knows what is meant by leasing. We take the asset on lease from somebody. So, we do not have money to be buying it, or even if we have that money, we don't want to be giving that money. So, therefore, instead of buying the asset, you lease the asset. Okay. So, lease is always external in nature. Okay. Now, in lease also, there are two options that are there in your syllabus. You either have short-term lease, which ultimately takes the role of operating leases, whereby you hire the asset for lesser than the economic life of the asset. Suppose for a small example, you hire a truck. Truck's life is say 10 years. You hire it for a period of 1 year. That is called as operating lease. Or leases can be long-term in nature also, which are many times called as financial leases. Okay. Financial lease, it should be financial lease, I think. Okay. So, financial lease is basically whereby you almost take the asset on lease for the entire duration of the economic life. Suppose truck's life is say 10 years, you hire the truck for 10 years only. So it is called as finance lease because ultimately the lessor is financing your asset. That is why it is called as finance lease. Okay. Now, the last one that is left over here is nothing but your retained earnings, also many times called as reserves and surplus. Now, reserves and surplus in this case is always internal. Try to be thinking, how does reserves and surplus come? So, reserves and surplus come by way of profits generated. Absolutely correct. So, therefore, it is always generated internally. Nobody is giving you money for reserves and surplus. Nobody gives you the money for retained earnings. It is always internally generated. Okay. And usually your retained earnings is for long-term needs, although it can be used to finance your working capital. It is not rule as such. It can be used for short-term also. Okay. So I guess so, out of all the answers, retained earnings is not external. It is internal in nature. So therefore, that should be your answer. So external sources of finance do not include, answer should be B, retained earnings. Yeah, that is the correct answer. That's it from my side. I'll see you next time in another question. Till then, take care. Bye.